Welcome back to Rise and Shine, where we discuss everything to do with real estate investing. I'm Jim,
And I'm Irismar.
and we are here to bring you the wisdom from the leaders in the field.
And today we are thrilled to have a very special guest, George Dube of BDO Canada. George is not just an accountant, he's a strategic ally for real estate investors, known for his deep understanding of the tax implications and financial strategies that can make or break an investment.
You know, George has years of experience advising real estate investors and his own journey in the investment world. George brings a wealth of knowledge that's both practical and transformative. Now, whether you are looking to optimize your taxes or expand your portfolio or just understand the latest in real estate financial strategies, George has the insights that you do not want to miss.
So get ready to deep dive into the financial side of real estate with one of the best in the business. It is an episode filled with valuable takeaways that could redefine your approach to your investments.
Love it. So without further ado, let's bring on George in here and let's learn because it's an opportune time to have George on. It's tax season and everybody's getting busy. George, you're still muted there, but
Welcome.
thank you so much.
Thank you.
Great to see you. I know you're busy, so I really want to thank you for making the time with us this week. It's just got to be a hectic time of year for you as it is for us real estate investors.
I think so, but there's also a kind of a special privilege, if you will, for me to be here in the sense of the ability just to be talking tax to people, and people are listening to me. People are really engaged right now as compared to in the summer.
Very true, very true. And that will lead us into the discussion today, right? Just to give us, that advice of investors, right? Both new and seasoned.
Yeah.
What
Yes.
is that we can do to start maximizing those tax deductions?
Yes. And I mean, there's a whole lot of things that people are talking about right now, right? In terms of people are, at this point in the year, probably a little bit panicky. Most people haven't yet sent all their information into their accountants, but they're hastily trying to scramble and get it all together. And yes, they're wondering what the big number is going to look like when the return has been calculated. And it's good and bad in my mind. So the good part is people are trying to get ready. And I can assure everybody their accountant will appreciate it if they can get their information in March as compared to in April. So the sooner the better. But yeah, now is the time to be scrounging through. And it's also, I think, a big opportunity to, as silly as this may sound, remember what this panic feels like, what this experience is like in terms of what we're going through, and resolve, I don't want to do it next year. I want to be more organized. I want to already know what my tax number is going to look like before I hand it off to my advisor, because I sat down with my advisor, figuratively speaking, and we calculated it in the fall or the summer, depending on a variety of factors, what my taxes were going to look like within a reasonable plus or minus amount, if you will. But it's been taken care of. So now I won't pretend that it's ever going to be completely stress-free, but I'd like to think it's less stressful.
Right.
Right.
I mean, one thing that we've learned since we've been on this journey of real estate investing is that you want to work very well with your real estate investor focused professionals, and that's lawyers and accountants, and just so we're not dumping things on you guys at the last moment. I mean, you guys have a life, you have a family, you have your commitments that you want to make as well, and it's better that we're in a more organized format as investors so we can hand it to you near closer to the end of February, beginning of March.
Yeah, and it's probably quite honestly not possible to get it to us at the end of February. We're, with some exceptions, not really going to dive right into it until the second week or so of March.
Right.
And the thought process there is a lot of times, because, for example, T4 and T5 slips, they're not due until the end of February. A lot of our clients won't have received those. But the trick comes into a lot of folks will be investing in limited partnerships, for example, or even mutual funds to some small degree, perhaps. But those slips are not required until the end of March. And so we may not have complete information, being realistic about things, till the second week of April or so. And that's where it creates a panic. And this year, and maybe it's my imagination, but this year I've perceive that I've seen a lot more media reports in terms of thou shalt go out and love thy accountant, because there's not a lot of accountants accepting new clients right now, in part because of new legislation related to bare trust reporting, which is required by the end of March, which a lot of real estate investors, whether they know it or not, they have an issue there. And so this avalanche of additional tax returns is coming at the advisors. And it wasn't like we didn't have a few things to do already during this time of the year. But now we're trying to, I was going to use the term comfort, but I don't think that's the correct word. Maybe let's stick with advise clients with respect to, wait a minute, are we missing these bare trusts? How does this fit in with the corporation, the personal, the this, that, the other thing? There's just a lot more to do. And as we have fewer people getting into the industry, and it was already, for most accountants, kind of, there's a plus and minus to kind of February, March, April work, in the sense of, one, on the plus side, we work really long hours for the most part. And it's a lot nicer to work those hours now as compared to in the summer. If I have to trade off some months, this seems like a great idea. But on the same token, it might be a little hard, particularly around the last week of April, to remember the ideals of that trade-off and say, yeah, it's a very compact period of time where we're dealing with the vast majority of our clients. It's stressful for everybody. Sometimes some etiquettes are perhaps not quite as strong as they would be at other times of the year, and we're trying to manage. We're trying to let things roll off our backs. We're trying to help, but we're not going to be as fast in terms of getting back to people or doing things. And it's not a lack of effort or desire. It's simply there's only so much time in the day. And as you said, we're trying to, while we're kind of, to a degree, I don't want to say ignoring our families and other obligations. I literally, just before popping on here, I was at my church, and we're doing some significant work to the parish, or the structure of the building. And so our little committee is going through some things with the architects and what have you. So it's not that we are only doing one thing, but no question, when over the years, as we've had end of busy season or tax season celebrations, parties, I haven't been able to do it per se with BDO, but prior to joining BDO, my partners and I, we would specifically invite the family and try to, in a jokingly fashion, reintroduce our team to their families, but thank their families in the sense of they've allowed their team members to work so hard for the firm and our clients. And now the payback is, okay, you guys went gangbusters above and beyond, and now is the time to, there's a debt that gets accrued each year, essentially. But it's also something where, as much as some of us may complain about it, we also get excited about it too.
Now, you mentioned Bear Trust, and I know that's a newer thing for this year, and you said that a lot of investors are going to have an issue with that. Can you explain a little bit about the Bear Trust?
Sure. So in a non-technical terminology format, if you will, I like to describe a Bear Trust as an entity or a relationship where the legal ownership and beneficial ownership of an asset are different. And so, as examples for real estate investors, often a joint venture agreement, for example, may have differences in legal versus beneficial ownership. So if the three of us, for example, were acquiring a property, and let's just say our families were splitting it 50-50, but I have a bad credit record for whatever reason that may be, but I've got lots of cash, for example, so we may not want my name on legal title for financing purposes. So perhaps your names are on title, mine is not, but there's an agreement that says we're splitting things 50-50 in my example. So there's a bare trust, essentially, where you have legal ownership of that property, but half of it belongs to myself or my family. Another common example for real estate investors will be they have a corporation, but they are rightly or wrongly acquiring financing in their personal names. And so they will have essentially corporate ownership, beneficial ownership of the property is owned by the company, but they may personally be on title from a legal perspective and a mortgage perspective. A bare trust exists. A bare trust can exist, if I can give a non-real estate example that may be applicable to many real estate investors. It is that you may have elderly parents or young children that are minors. And the common example with the older parents is, well, why don't we add our name to the bank account, investment accounts for probate planning purposes, depending on which province or territory we're part of, or simply for ease of administration and taking care of our parents. A bare trust probably exists. If we're holding assets for young children, they're not, typically speaking, allowed to own an asset until they've reached the age of majority. We're holding something in trust for them. So we start to get into a host of examples. I deal with a lot of medical professionals, and there's an assortment of business arrangements where they have bare trust agreements. And so the problem with all of this is it works wonderfully from a tax perspective, but this is the first year where Revenue Canada has decreed that we have to file a disclosure return to Revenue Canada to say, here's all the details of who's on legal title, who has beneficial ownership, and who's, they call it a settler of the trust, which let's kind of skip that part of the discussion if we can. And the identification of all that information does not specifically trigger income tax, but Revenue Canada has an enormous carrot and stick approach. Well, let's rephrase that. They have an enormous stick approach. So what they've done is say, if you don't file the tax return, you're potentially liable for a penalty equal to 5% of the value of the assets. You had $1 million home at 5%. If my math serves me correctly, that's a ginormous number, particularly if Revenue Canada finds out 4 years after the fact, and I've got a few years of penalties to catch up on. It's devastating.
Yeah.
Yeah. Wow.
And Revenue Canada has indicated administratively they didn't think they would apply as many penalties in the first year if it was inadvertently missed. So now we have a big question. Does George's definition of inadvertently match up with Revenue Canada's or match up with the judges? Not very likely. Hasn't for the past 30 plus years. I doubt if it's going to tomorrow. So a lot of people are out there saying, oh, don't worry about it. They're not going to apply penalties. No. That's not what Revenue Canada said. They said they weren't going to attack us if it was inadvertent. Who knows how that's going to be interpreted?
Yeah.
And certainly if I'm a Revenue Canada auditor, and again, I'm not trying to be anti-Revenue Canada. I don't mean it that way at all. Most of them are normal people. I get along fine with most of them. But at the end of the day, it's certainly a lot of leverage for an auditor to use in terms of getting some cooperation from taxpayers.
Wow.
So that's just, it's a crippling penalty.
Yeah, and when I worked in the bank decades ago, it was very common for somebody to come in and say, I want to add my, an elderly person to say, I want to add my child, my son or daughter to my accounts because
Absolutely.
when I pass, then it's in their name and they can take it on. But this is where the problems lie.
Yeah, and there's exemptions in certain cases. So the common exemption being referenced is that there's a threshold of $50,000 of value through the year, where if, for example, that bank account is always underneath 50,000, and that's the only thing we're talking about, we don't have to file. Part of the trick, though, is it's not $50,000 for everything. It's $50,000 of certain assets. And so as an example, one of the primary exceptions that we're seeing, and I see it a lot with my healthcare professionals, where they've set up a professional company or an investment company or both, or all sorts of different things going on. And they want their minor children to have ownership of some special shares or preferred shares, depending on the terminology used in the various provinces. But again, because they're minors, they're not allowed to own the shares directly. So at some point in time, these special shares were created. Private company shares have no de minimis test. And so the $50,000 doesn't apply. Those shares may have been issued for $10, $100 tops probably. But so the 5% penalty there is not going to kill us. The other penalties they can, and it can get up to $2,500 a year. And no, that's probably not going to be a earth-shattering financial event. But if you've missed it for 3 or 4 years, it's not going to be a pleasant event.
Absolutely, yeah.
Now, are there any, I mean, thank you so much for that, because that clearly is an eye opener for the investors, especially if they have not only started to build their portfolio and they have those joint ventures in place. Now they should have a discussion with you to actually say, okay, do we need to disclose them because they could fall under that bears rules now?
Right.
Great awareness. Now, are there any other tax rules that investors should be aware of right now?
Anything new that's come out that the government has come out in the past?
There are new rules, but there's, and I don't mean to diminish the importance of doing personal tax returns, but I find too many people, they're focused on, and I don't mean this in a cruel way, they're focused on what I'm going to call Mickey Mouse deductions and credits. In that they tend to be, particularly in election years, new credits issued for this, that, or the other thing that are $500, $1,000, whatever the number is. And by focusing on those types of things, I think they're getting away from the big picture. And the big picture involves, how am I structured? How am I flowing money? How am I holding my assets? How am I looking for legacy retirement, estate planning, where I'm saving thousands and hundreds of thousands of dollars as compared to my Mickey Mouse credits? And so every year there are new credits and little deductions. And quite honestly, I haven't reviewed any of the tax returns yet this year. I haven't done I don't even know what they are this year. But there's nothing there that's going to be of importance. I'll describe it that way. Irritants, if it's missed or something, but until you kind of start looking through them, we don't pay close attention immediately. What we are paying attention to is those bigger picture items, and some of those bigger picture items. Now, this will be for more seasoned investors, but for example, there are rules out there now that are restricting the amount of interest deductions that are allowed to investors. And so now there's profit tests involved. There has to be a threshold met. I accept that. There's also legislation out there now where if we're doing what I'm going to call some more advanced tax planning, somebody else might call aggressive tax planning, but we have to identify in a variety of situations to Revenue Canada directly and relatively quickly after the plan has been implemented. Here's what we've done. Here's what you might not like about it. We're kind of waving a red flag against ourselves right to Revenue Canada to say, please kick me as hard as you can. And so that, forgive the expression, but kind of the gentleman or the gentleman club or the boys club or whatever, in terms of that level of cooperation that existed between professionals and yada, 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 it seems to be disappearing. Whenever I have to start flagging myself for the planning that I'm doing, that's taken a lot of the game out of it. And I shouldn't call it a game. I'm not trying, again, to be a smart aleck about it, but no doubt about it. I mean, as a tax advisor, as an accountant, it's not like I don't enjoy chatting with Revenue Canada and arguing my clients' points. That's part of what draws me to it. It seems like I'm giving up on the game because I don't have the chance to fight anymore in some cases. And I think those types of bigger picture items, in terms of the structuring and whatnot, are far more important than there's another $1,000 credit for this, that, or the other thing.
Right.
And don't get me wrong, there's a lot of things we're still able to do. It's not like the world has collapsed. But as they also have a set of rules that was introduced in the late 80s. It's called the General Anti-Avoidance Rule. And when it came out, there was the warnings, hey, this is a slippery slope. It was much more conservative then, and the general idea was that if Revenue Canada didn't like the planning that was being done, they could reverse it from a tax perspective. And so retroactively, they canceled the planning that could be done. And so there was a very limited amount of cases where they were allowed to do that initially. But over the years, it's been expanded on. So, and again, now with some new legislation this past year, there's a lot more discussions in our office about what the implications of GAR is going to be. And so again, they're taking away some of the sportiness of the the fight, if you will.
Yeah.
It's not to say there's not different things to be done. I'm not saying that, but now we have to be more careful. But it also means for real estate investors, some of the things that used to be acceptable and some of the more cavalier attitudes, I think, about tax planning, they have to be re-examined to really see, what am I saving? What are the risks? What do I have to do with Revenue Canada? Whether we like the rules or not, we have to follow them. Do we want to bend them and interpret them in our favor? Absolutely. But there's still a set of rules there.
Right.
And in fairness, there are a number of rules that, while in existence, we don't know how to interpret them yet because they haven't had the time to go through courts and have judges basically tell us this is how they interpret those rules. It's pretty hard to write tax legislation that makes perfect sense. So it gets interpreted over the years by judges. And when something comes out, by the time you go through the audit process, lower courts of appeal, medium level courts, and ultimately a Supreme Court potentially, that's not fast. It's going to take 10-ish years type of thing before we even really get to know some of those rules, which then also means you've got 10-ish years before we really know what some of those rules mean. Now, don't get me wrong, we know what a lot of the rules mean, but we don't know some of the finer points and how they're going to be interpreted by the judges ultimately.
So based on those intricacies, how often should we be sitting with you as an advisor to make plans on how to save tax, grow our wealth, and ensure that we're maximizing the benefits?
I think that's going to depend on someone's situation and where they're at in terms of life cycle, business investment cycle. So somebody that's just starting off, for example, we may not be meeting as frequently, but somebody that's got a little bit of money behind them or access to capital, maybe we should be meeting more because it's more important to set it up right the first time as compared to change it down the road. So some of my clients, most of my clients, if I see them 1 or 2 times a year from a planning perspective, that's usually good. But some of my clients, I'll see them monthly or quarterly. They've got more things that are going on. One of my clients right now, and it's a short check-in, but it's a 15-minute check-in every Friday, for example, just because there's a lot of things going on, and that may not generate an enormous amount of work or anything of that nature, but it may generate, oh wait, we got to check this out, check that out. Let's get Billy Bob to do this, Betty Sue to do that. And Billy Bob or Betty Sue may not even be part of my accounting firm. They may be lawyers or architects or this, that, or the other thing. But there's a team environment that's needed there. So most of our clients, as I said, I think are well served. They got 1 or 2 planning meetings a year, but where there's more transactions going on, something new going on. If somebody's buying a property every month, just for example, but they're using the same process and entities and strategy, it's not like you need to talk to me each time because you've probably figured it out after the first couple. But where we're starting to get into different strategies, different types of investment mixes, anything different, really, different investors, different family members involved, bigger dollar figures. When things change, that's when we like to see that check-in. And sometimes that check-in can be really, really fast. And sometimes it just takes an hour. One of the stories that I like to tell is one of my clients that we were, over the years, I thought I knew her reasonably well. And but she was telling me, as dumb as this sounds, she was telling me about her kids going to a hockey game. And she mentioned this vehicle that was being driven. And I thought to myself, wait a minute, that means there's 3 vehicles. I was aware of 2 vehicles. So for a few years, we were unaware it was a 3 vehicle family. We were missing the deductions on that 3rd vehicle until we started about taking the kids to hockey.
Wow.
I mean, nothing to do with tax. It's just, I got to know the person better because they had inadvertently forgotten to fill out they filled out checklists and things, but they didn't do a great job with it. But just knowing someone a little bit better starts to allow the advisor to, how can the tax rules work for you? We try to send out newsletters and updates for new things that are coming out. I think we're pretty good at that. But a lot of people are going to see that, not understand how it applies to them, so they really didn't do anything with that information. opportunity to sit down and chat with the advisor, and now allow that advisor to kind of get into your head. Now, all of a sudden, if you're working with a good advisor, they're going to be able to start, oh, wait a minute, you should be aware of this and you should be aware of that. Now it's personalized as compared to a mail out from a newsletter.
Right. And that's what a lot of investors really look forward to is having a more personalized experience, somebody that knows them by name and not just a once a year kind of transaction, fill my taxes. So that's excellent.
Right. And if somebody's looking for us to do their tax return and that's it, and there's no advice or things of that nature, I mean, it's not that we're not willing to do that, but there's lots of accounting firms that can do tax returns and financial statements. I mean, I think ours looks pretty. Don't get me wrong. I like the red, the white, the blue colors. That all's nice. But somebody might like the green colors, the purple colors, the whatever colors. Everybody's got a pretty logo. It just depends on your perspective. What's the true advice that's able to be provided? And so from my perspective, a lot of people, yeah, I mean, myself and my team, I think we're pretty smart. But we also have the ability to talk, well, this is what I do in my portfolio. This is what I see other people do. Now, that's useful information. Not that a tax return, a financial statement's not useful, but I mean, it's almost grocery store level. It's a commodity.
Right.
Whereas talking to me, one of the best questions in the world is, what would you do, George? And now all of a sudden, forget all the complexity and you don't know this rule, that rule, or other rule. To me, that hits it right on the head. Bang. I either know or I don't know. I can either advise or I can't advise. I won't tell somebody you should buy 123 Maple Street versus 456 Queen Street type of thing, but I'll tell you what George would do.
Uh,
And I'll tell you why George would do that. And to me, where some of that dynamic works in really well is, okay, George, now let's say you didn't have a focus on this, that, or the other thing, or you didn't believe in this, or you were kind of I'm more than happy to disclose my biases and why I think things. And so now I can get better into somebody's head or give them even better advice where they say, okay, George, if you took that part out of the equation, now what would your answer change? And so as a quick example to that, to say, maybe I am saying, not that I'm a lawyer by any means, but maybe I also have a little bit of a bias in the sense of I'm trying to protect my assets from a legal perspective. And whereas now, if you tell me, okay, George, stop thinking about that factor, just focus on financing and other parts to this, or stop thinking of financing, or again, so whatever that may be that you're trying to bring in or out of the equation, great. Now I know what that frame of reference is, and again, happy to discuss those iterations to the thought process. And to me, that's where the light bulbs go on, and that's what's going to segregate myself from the average advisor that may or may not have a real estate portfolio, may or may not be working with a variety of investors. But to be able to start to bring that technical and the practical together, having been there, not that I've done everything by any means, and I've done dumb things too, but why not learn from those?
That's right.
There's no need to do them yourself. I can I should say, trust me, they weren't any fun the first time. You won't enjoy it either. So learn from that. It's far cheaper.
I love that. And I love, we got introduced to you 4 years ago when we joined this investor community. And, I was skirting around, you're looking for your bio earlier. And I read that, your mission statement is to help people build and protect their real estate portfolio and businesses so they can do wonderful things for their families and their causes. And that really shows the more personal side of this type of profession, and what your team does is having a more personal approach to your clients so that they can achieve to do better things with themselves and their families and have more time.
To me, again, from a spiritual religious perspective, I think we're on this world for a short period of time. It's a test case. And if we have the ability to do good things while we're down here and help others do that, and for most of us that are investing in real estate, think of all the awesome things we can do for families, tenants, people we're working with, potential investors. Like, I mean, the list is almost endless what we can do. Why not open up those doors and getting into kind of where I started from a real estate perspective in the sense of acquiring the first property. Well, saw the profits and what was done and the value increase, and Well, if you can do it once, you can do it twice. If you can do it 2 times, you can do it 4 times, et cetera, et cetera. It's the same in the communities and whatnot. And to me, it's not that there's not a financial component of importance. Obviously there is,
Sure.
but there's got to be something more than money.
Absolutely. And that's one of the things we're very honored, because the people that we've situated ourselves with and that we've been introduced to in real estate investing, it's about doing what's right. You know, the tenants are of utmost importance, their safety, their security. You know, these people could be our friends' families, they could be our families in another city or another portfolio, somebody else's portfolio.
I love thinking of it, just the simple concept of, would I be willing to have my daughter live there?
Yes.
Yeah.
100.
And it doesn't need to be a mansion. I'm not saying that, but there needs to be certain levels of quality.
Yes. No, I appreciate you saying that, because that's one of kind of like our drivers. Like for me, I'm like, I have to be comfortable even when I'm walking through a property. I have to be comfortable stepping into that bathroom, and I need to be comfortable stepping
Right.
into the kitchen. If I don't feel that comfort level, then there's something is wrong, and that is elevated, brought up to a new standard.
Yeah. And again, it doesn't need to have gold-plated faucets and ivory, this, that, or the other thing, but no question, it can't be a dump.
Now, tapping into your expertise as well as some of your personal experience into investing, as you share, are there any strategies that you personally use to maximize those tax savings?
I think there's quite a number of things that I do, and so it's really more layers and layers and layers as compared to something isolated, if you will.
Okay.
And so that, starting with a foundation. And to me, that foundation is often the bookkeeping, the organization, the record keeping of what we're doing. So if somebody has that proverbial shoebox that they bring into their advisor in March and April to say, here it is, that was a poor system. I like defining a good system. Is, imagine being audited and Revenue Canada comes in and they take a look at your expenses for, let's call it repairs and maintenance. They see there's 15 items down on the list for the year, and they point to 3 different amounts and say, show me those invoices. If somebody can do that in like 5 minutes, they've got an awesome system. No problem. They're going to be able to demonstrate what they've done, et cetera, et cetera. The contrary part to that, of course, is you can't produce those records really quickly. And now you've just told the auditor, I'm not very organized. Shouldn't you ask me more questions? Because we probably didn't do it right the first time. Definitely didn't do it right second time. And this is probably your single opportunity as the auditor to become prime minister tomorrow, if you can find some more money out of me and solve the national debt problem, because I can't support any of my deductions. So again, obviously exaggerated a touch, but that foundation is critical. And easy to do, but it probably gets more challenging for more seasoned investors, because we may be using processes that we were using years ago that are no longer standing the test of time. And so now we move past that. And to me, the big part of the tax savings strategies is looking at the structure. How do we own the properties? Who owns the properties? What entities? Do we have family trust? Should we be using a GPLP structure in some cases? Corporations are, for the most part, kind of a standard. And good, I love corporations, don't get me wrong. If we're continuing to own everything personally, I mean, let's take a look at that, because that's probably throwing away a lot of money. And one of the simplest examples to it, I get a little frustrated, and as accountants, we're probably one of the worst for it as an industry, I think. We tend to focus on today's taxes. Quite honestly, I don't care about today's taxes. I'm much more interested in, what are my taxes going to be 5 years from now, 10 years from now? What's going to happen when I'm retiring? I've passed away. What's happening with my legacy? Those are where I'm saving hundreds of thousands, millions of dollars, literally, as compared to worrying about, did I get everything I should have out of today's tax? Not that I'm trying to throw away today. I don't mean it that way.
Here.
But far more concerned about down the road. And there's different techniques that we can use from a planning perspective to help people extract money from corporations more tax efficiently. Just having the corporations allows us to plan, when should we be taking money out? How should we be planning to take money out? There's an assortment of techniques out there, or as I talk to my team, tools that can be used to help different investors in various situations. A lot of those tools are going to be boilerplate in terms of the concept, but very unique in terms of how they are applied to a specific person and what group of tools is beneficial in that situation. A lot of similarities in different cases, I don't deny, but it's fairly rare where people come in and I'm going to propose the same solution. And in fact, initially this may seem odd, but if I have two couples come in, for example, back-to-back meetings, identical situations, it's not unusual for me to have two different solutions. And the reason for that is that different couples will have different levels of importance, different plans for the future, different objectives that are going to indicate, well, a different set of tools is probably applicable here. And so it's not that we're just trying to randomly guess and put a solution in place. It's no, I think we need to spend some time to learn what's going on and develop a framework that is going to allow for growth, expansion. And for some people, it's going to plateau or even contract or go to the next generation. But often it's a combination of different things. And to me, that's a part I love, is being able to talk to people about their situations. I don't like doing your tax return. I don't like doing my tax return. I don't like doing anybody's tax return. But I love looking at the tax return after somebody else has done it and using that as a tool to do the planning. And so to me, it's about the planning, the actual process of doing tax returns, financial statements. I've got a team to do that. I wish they would do mine. I don't like doing my own at all. Literally, I don't like it. But it's critical to do because that's what helps with the planning. And obviously, I don't want to pay the penalties to Revenue Canada for not doing it. I don't want to incur the bank's wrath in terms of not being able to report on the statements. I want to have access to capital, et cetera, et cetera. But that part, that's what I got a team for as they develop their skills and as they receive more experience and opportunity, then they get more focused on planning and proactively helping as compared to reactively doing tax returns and financial statements.
So taking it into that, I'm in this position right now where I'm reacting into getting my taxes done, but
Yes.
I'm here, I'm getting it. It's going to be finished, right? What are the next steps for me to set myself up for, call it, the remaining of 2024 as well for 2025? Looking at
and to me, those are the perfect types of questions. And so in my mind, like I try and dramatically decrease the number of meetings I have in March and April because I'm trying to help as many clients as possible. I don't do tax returns at this point in time, but I'll have my team members asking me obviously more challenging questions regarding those returns and planning for it. So I'll see segments of or review the overall picture, but I don't do anything, if you will. And most people would say that's probably a good thing. Although it does put into question why I do my own returns, but that's a separate problem. But now we get into, okay, if you can't really meet with the advisors in March and April because they're going gangbusters, it seems like a good idea to say, why don't we schedule a time to be talking in post April 30th, sometime between kind of July and August is great in terms of lots of time to, I should say lots of times there's vacations and things like that. But I mean, it's a little bit more of a warm, comfy, cozy feeling. I mean, who doesn't like to spend some time in the sunshine talking about taxes? I mean, it doesn't get any better. And so to me, it's, okay, George, I understand you're really busy right now. I understand your team is. Let's set up a meeting for May 18th, or I don't even know when that is, but anyway, set up a date post April 30th to say, we're going to meet and start talking about these things and getting that into the calendar. And I can assure people, based on the last several years, by the time April 30th rolls around, my May calendar was booked sometime beginning of April.
Oh, wow.
So kind of, and I've already started booking May appointments. So it's something, yeah, let's get those May, the June, July. It's often a lot of those things are not super time sensitive, but they're sensitive in the sense of, I don't want one more year like this. And so let's get the ball rolling over the late spring or early summer so that during the late summer, fall, et cetera, things can be implemented and we're ready to go for the year or the next year. Or alternatively, it may also be, things, they really look good the way they are. We don't need to sell you a super duper strategy for this, that, or the other thing. It's pretty good the way it is. And to me, there's also value in that. Now, don't get me wrong, most of the time I'm going to see a value to tweaking something. And normally I can show, okay, here's the financial consequence of staying the same, or here's the benefits of changing. So usually the math is pretty self-explanatory. It makes sense to do things. But sometimes it just, things are just, they're okay the way they are. Let's talk again next year and see how things are going. And so it's also trusting the advisor to make sure that they're looking after your best interest as compared to perhaps their own. And I think most of my colleagues, not just at my firm, but other firms, they're pretty good people for the most part. I go out and it's not like I don't have the opportunity to play some golf, have a drink with colleagues at other firms and chat with them. Do I think our firm is better? Obviously. But they're good people, right? And it's just finding those people that are specializing in real estate investing, development work, etc., and are also practicing it. That's a key part. It's not so. Again, I work with quite a number of healthcare practitioners. Well, I can assure you, I'm the last person you want in the operating room taking care of your heart. I have zero experience with it. Will hope I never have any experience with it. But on the real estate side, I have no excuse for not being able to do some investing. That doesn't mean the advisor needs to have the whole shooting match and a ginormous portfolio, but I certainly think they should have been exposed to the concepts of dealing with the financial institutions, insurance, accountants, lawyers, tenants, property managers, this, that, and the other thing. Otherwise, how are they giving you real advice? They can talk about taxes, but honestly, my impression in going through my schooling and whatnot, and again, I think I went to a top-notch school. I don't think there was a better one in the country, but we were kind of taught that real estate was bad. It was horrible from a tax perspective. And it wasn't until, without getting into the long part of the story, it wasn't really until I did a variety of self-study that I could start to reconcile what I was taught versus the realities of investing. And, oh, wait a minute, this is not what we were taught. This is, and a lot of that is the focus as an industry, unfortunately, in many cases, was on analyzing what the taxes are today, not what was going to happen over 10, 20, 30, 40 intergenerational years. All of a sudden, the whole attitude, it almost reversed. Dramatic change. And I stand to be corrected, but I would suggest most accountants probably went through a similar education type of process.
Wow. I am now, there's a few things there that you made me think about. In terms of planning for taxes, now I can imagine everybody, a lot of investors, they talk about the receipts, keeping the receipts and all that sort of. Do you, George, have a preferred or a suggestion of a software or an app that it seems to make that a lot easier for investors?
I have the perfect system, in my opinion. It's called Robin. And so when I hand it off to my wife, it magically gets taken care of.
Okay.
And so it's fantastic. Haven't seen something better.
Can we get Robin? Can we get Robin's? So we can send her all of our.
Yeah, I don't know if it's going to work as well for you, but not being a smart aleck for a minute. I do not know what the best systems are right now. I have an individual on my team. His name is Jeremy, and he's a lot smarter at that than I am.
Okay.
And so what we and actually as partners for our firm, we were exposed to a variety of different software and ideas and things that they were doing basically kind of in the fall of what our teams were researching and putting together, et cetera, et cetera. But the apps and whatnot, they're changing all the time, right? And some of the ideal ways of doing things. And so we're trying to get things such that clearly they're more and more seamless, et cetera, et cetera. And so it's a perfect question, very, very legitimate. And I think people would do very well to be exploring that. But honestly, George himself doesn't know George refers to Jeremy to say, Jeremy, what should we be doing here? And so I think a lot of advisors would say something similar, where it's pretty hard to be keeping up on 4,000 different things, and tax rules and accounting rules and bookkeeping and app programs, things of that nature. Admittedly, Robin and I are this summer going through the process of reevaluating how, like Robin does like 99% of our stuff, as you can probably tell, but reevaluating how we're doing things. And so if we're reevaluating that, shouldn't most people?
Yeah, that is a good point. And I think you bring us back to kind of bringing it all together, that it's never too late to have the conversation, sit down and revisit the strategy. Because there's still, I would say, based on what you shared, like, yes, we can have a conversation on May. Maybe a junior investor, or not as, seasoned and open to the experience, will say, well, but the year is almost over. So what would be the component of savings at this time if I already missed half?
Right. And so a couple comments there. One is to say, yes, but that means then next year when you're in the same spot, you've missed one more year. Next would be, well, it's still a half year of savings, or in some cases, we actually can get more of that, which is a longer explanation. But to me, it's like, when's the best time to buy real estate, right? We've all heard this. Well, today's the best. Well, sorry, today's the second choice. I even screwed that up. The best time was 10 years ago or whatever it was. Next best is today. The least best is a year from now, but that was still better than never, type of thing, or 5 or 10 years. So again, the sooner the better. And the other part there, I think as seasoned investors, we get into an overly comfortable feeling that our system's in place, we're doing things marvelously. Wait a minute. I have seasoned investors literally that are throwing away 50,000 plus. I have one that's $750,000 every year they're throwing away because they don't want to change their system. And so I don't think you have to be much of an accountant to figure out, at $750,000 a year, you could have hired a bookkeeper or two to implement the system, and you were probably going to be ahead of the game. So I find some of our seasoned investors don't accept change as well as perhaps they should, or they don't recognize that it's required because they thought, hey, I just set this up like 5 years ago. My lawyer, I had top-notch accounting, legal, insurance, financing, blah, blah, blah advice. Well, that was wonderful, but what have you done for me lately? The tax rules have changed, the legal rules, the financing, lots of things. My family situation is going to change. My investing strategies are going to change. And part of the focus too, and I love this part about real estate investors, in that they like using other people's money. And so one of the big things in investing, of course, is to use OPM. Let's stretch that a little bit further. Who would you like to have pay for your taxes? Do you want to pay them, or do you want somebody else to pay them happily? To me, that's an easy decision. So let's use some strategies. It's not applicable for everybody. But if I can get somebody to pay more of my estate taxes, for example, I'm going to call it, it's not a technical term, but as a real rough number, just to kind of leave with people, it's to say, if there's no planning being done, the second of a husband and wife passes away, married couple, I shouldn't just say husband and wife, but the second of the couple passes away, and that planning is not done, roughly speaking, they're going to give away 25% of their estate to Revenue Canada. Now the kids get, assuming there's kids, or nieces, nephews, church, cancer society, doesn't really make any difference. They got 75 cent dollars. Wouldn't it be nice to get the full, add that 25% back? Yeah. And there's ways of doing it. Now it's time to talk. And 25% of my net worth when I'm hopefully a lot older, but that's not for me to decide specifically. Right. That's going to be a big number for most of us. And whether we're talking $1 million, well, $1 million, probably my numbers don't really work out for, but it doesn't take much beyond the million for those numbers to work. And all of a sudden, 25% of 3 million, 5, 10, 20, 100, whatever your number, that's a number worth talking about, I think. And so if I can get somebody else to happily pay for my taxes, and it's all done completely above board, legally, fully disclosed, yada, 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 I think that's worth a discussion.
Absolutely.
100%.
Now, another thing you mentioned and made me think too, and I think Irismar and I were certainly guilty of this as well as when we were starting off and in real estate investing, we think that we need to incorporate right away and shelter the taxes. Is that always the best strategy, or what's your word of advice for newbies starting off?
Yeah, I won't say it's always the best advice. I think it's frequently the best advice. So if I can, let me give an example there. So somebody that's going to start off and they're investing and they bought $100,000, I don't even know if those exist today, but they bought $100,000 property somewhere and that's it for the rest of their life. I say, congratulations, that's awesome. You're better off than the vast majority of Canadians. But most of the investors that we're talking to, they want to acquire a little bit more of a portfolio. And so if the general aim is to say, I like to describe it, if over the next 3 to 5 years, you're going to be in the kind of a little bit less than $2 million range in terms of property value. I don't mean equity, I mean the value of the property. I think the corporation in most cases makes sense. $2 million over 3 to 5 years is not a big hurdle to hit. And so if I don't set up the corporation on day one, I may own a handful of properties personally. And now if I'm trying to protect myself against this evil 25% tax, for example, and other taxes, I have to transfer those properties to the corporation. And so that means I need lawyers and accountants. I need to be talking to my bank. I've got a lot of coordinating to do. And I've got Revenue Canada saying, we think this is a fantastic idea that you sold your properties to yourself. Please pay the tax as if you sold it to an arm's length person. And we can get around in most cases paying that tax by filing certain tax elections and working with the legal team. But it wasn't a free service. I mean, there was a cost of doing that. And depending on the province we're talking about, a lot of people love paying the land transfer tax. I can guarantee you, if you get a chance to pay it twice, you're going to be just unbelievably over the moon. And so all of a sudden, we've got land transfer tax applicable, lawyers and accountants. And as happy as I am to receive the check, don't get me wrong, I would have been far more valuable if we would have invested that into planning, set up the corporation right the first time, even if the corporation was underutilized for the first little bit, as compared to all those costs in trying to fix it after the fact. So if we know where we want to be, in many cases, I think we should get there. Maybe it's still simplified. We don't necessarily need to start off with kind of the Taj Mahal of structures and 18 different companies and family trusts and this, that, and the other thing. It can be really, really, really simple. But that's still far cheaper than doing things that were perhaps initially seen to be cheaper because it costs money to set up a company and to do tax returns and financial statements for the company. But it's a lot cheaper than paying land transfer tax again and paying the lawyers and accountants and worrying about the banks and all this sort of stuff. And heaven forbid the protection element, and heaven forbid using some of the strategies that are available that are not available to the same degree as for personal ownership as compared to corporate ownership. So I'm also handcuffing my professionals if I don't have that structure in place. Because if somebody owns everything personally, to a large degree, come tax season, we're counting beans. There's no strategy involved. The numbers are what the numbers are. I mean, there's a little bit of exception to that. I'm being a little bit over dramatic about it. Whereas with a corporation, though, there's planning involved. There's real things that can be done. I can't do those same things if my client just has everything personally. So yes, I love corporations. Yes, I think people, when they're starting off, should be using corporations in most cases, but not all cases.
Love it. Love it.
I love it. I think it takes it back to, let's start with at least what is the end goal and then have the discussion. Because if we don't share that end goal with you, I feel that you might not be able to guide me as to the best structure for me to set up today.
Because I'm going to get you going in a direction you may not want to be in. And then we're going to hit the destination, right? That I'm thinking this is glorious. And you're thinking, George, you didn't even get me anywhere near where my expectation was. So just a complete difference that could have probably been really, really easily addressed if we'd have taken 15 minutes and really talked a little bit.
Yeah.
I also find it, if I can, remarkable in the sense of contrasting some of the, and there's lots of exceptions to what I'm about to say, but contrasting the attitudes of real estate investors with a lot of my healthcare practitioners. And one of the big differences that I've seen is the attitudes relating to retirement estates, legacy planning. As real estate investors, they get it almost always in terms of, well, that's why we're investing in real estate. It's a long-term gain. A lot of the healthcare practitioners, again, notable exceptions, they're coasting on good incomes. They're obviously extremely smart individuals, but I've had multiple cases, unfortunately more frequent than I would like to see, where they're now in their 50s, their 60s, they're ready to retire. They don't have a portfolio to retire on. And I don't mean they should have to invest in real estate, maybe completely non-real estate, but there was never a focus on retirement estate legacy planning. And now all of a sudden they're going to have, if they discontinue work, a dramatic change in lifestyle. Whereas a lot of the real estate investors, they're building to get to that lifestyle. A lot of the healthcare practitioners, they have some of that lifestyle as they're going along, but they're going to run over and find themselves looking over the edge of a cliff because they haven't done some of that planning. So that's one of the big things I'm doing with a lot of healthcare practitioners now, is while we're in our 20s and 30s, 40s, let's start looking at that. Why be like everybody else? Let's set this up for success. You want to enjoy retirement. You want to be able to give to your community, your family, this, that, or the other thing, whatever it is that's important to you. My job's not to decide what's important. My job is to show you how to get there.
Right on. I love it. I love it. Well, thank you.
Goodness.
Thank you for your time.
Thank you.
Busy time of season, George. There was a tremendous amount of information for our community out there. So thank you very much for that.
You're welcome. Love talking taxes.
And if people would like to get in touch with George at BDO, how do they do that?
Best way is through email, gdube, D-U-B-E, at bdo.ca. And admittedly, please give me a little bit of leniency in March and April. The timing of return emails and whatnot is not going to be as strong as it is in other times of the year. Yeah, the team's going gangbusters. But yeah, we'd love to be able to help people. And admittedly, again, a lot of media attention. Maybe a lot is the wrong word. It seemed like a lot for an accountant anyway, where I know there's a lot of accountants that are not accepting clients this year because of the variety of the changes. And our team has this, again, overabundance of filings that are required with these Barrett trusts that have never been required before. So we're not per se meeting with everybody beforehand. So a lot of the discussions are like 5 minutes, 10 minutes, whereas the real planning is going to be done after April 30th. So, but love to start scheduling some of those times to talk with people.
Wonderful. Well,
It was wonderful, and thank you.
Thank you. A pleasure.
For everyone that you can reach out, just understand the timing. And if we're just franticking now, we can easily wait to have a proper conversation and plan.
Right. Exactly. Thank you.
well, hang tight, George. We're just saying goodbye to everybody watching. Thank you so much. And we will see you next week on Rise and Shine. Have a wonderful week, everyone. Thank you, George.
Adios.